Look, tonight I thought I'd go through just some of the research I've just been undertaking. It's fairly broad form research in relation to trend following, but it's very interesting. And what I've been doing is I've been using your in-house EAs to ask questions in relation to things like optimization versus no optimization, curve fitting, all of those sort of things. Now, I know our members like Izzy on our forum has raised the dreaded word of curve fitting, and in the conversations on our forum, we were basically suggesting that there's no way you can avoid it. In fact, you need curve fitting to actually produce a result. What you don't want is a curve fit result, though, that responds to random data. But you certainly, if you've had a trending environment in the past, you therefore want to ensure that your algorithms can catch that trend, and that is a form of curve fitting.
I think the use of curve fitting is the wrong terminology. I mean, I know you're in a purest sense, that's what we're doing, but curve fitting has connotations that is not really what we're doing. So I think the wording is wrong. I think we need to clarify what it is we're doing. But I wouldn't call it curve fitting. I'd call it more data mining.
It is definitely data mining. And the question is, if someone raises, well, is that a curve fit result? So in the sort of quantitative circles, it's always been a dreaded word, this notion of curve fitting. And you can be over curve fit. In other words, your solution might be a complex algorithm that has many variables in it, that has specifically been configured to respond to that historical data, hence the number of variables that are in it, so that if his history is exactly repeated, yes, it will do very well. But as we know, you and I know, the future is uncertain, and that particular sequence, that data sequence that occurred in history, it shouldn't be used as a guide to dictate a future performance. What it should be used for, in my sense at least, is for robustness testing in ensuring that your hopefully simple algorithm, which hasn't got many variables, so the simpler the better, has been able to navigate that historical data without extreme risk occurring. So,
yeah, I think what you're saying there is actually absolutely correct, in that keep the system simple means that I mean, curve fitting by its extreme nature would be to put so many variables in that it actually matches the data stream that you've got, and that's not what we're doing. We're looking at generic systems which are very broad and looking to see which one of those carries across multi-markets, and I think that's what you're looking for tonight, isn't it?
Exactly. And one of the good things about trend following is that the different types of trends that people can define as trends, there's a huge different form of different variations of what people consider trends. There's the exponential price move that you might see in some of the cryptocurrencies, etc. Tesla, Bitcoin. You see these big exponential moves. That's a trend, but that's an exponential move. You can often get slow trends that mature over a long period of time. You can get volatile trends where it's quite noisy along the length of the overall bias in the data. So these are all different forms of trend. So to be able to have a robust solution, you want the most simple solution that can therefore navigate as many of those different various types of trend, as opposed to a prescriptive class of trend or a particular trajectory. You want it simple.
Yeah, agree. Yep. Keep it simple, and then broad. Keep it broad as you can.
Yep.
And away you go. So what do you got to show us?
Okay, so what I did was I used your superb in-house algorithms. So for listeners, we've got two different forms of workflow process here at the Traders Outpost. We we've got an in-house workflow process which is completed purely within the MetaTrader environment itself. But we also have another workflow process that uses quantitative tools such as Strategy Quant X to develop our algorithms for us. So there are two paths you can take in the Traders Outpost. One is totally within MetaTrader, which is a very cheap solution because you don't need any third-party software, or an alternative is using some of the off-the-shelf data mining tools like Strategy Quant, AdaptTrade, EA Studio, etc. They're all different third-party software applications that you can use to data mine. So we do have a solution based around Strategy Quant X. Some of our members are using that, and other members are using our in-house solution. So with what I want to show you tonight is what I've been messing around with the in-house solution that you developed, Fred. Probably listeners won't understand what we're talking about here, but our members will, who are using our in-house solution. But when we get to the end of our workflow process, we've got a particular algorithm called the Stage 5 Trader algorithm, which uses the Stage 4 workflow process, the settings contained within that, to then undertake a back test. And all of these different stages is a stage workflow process that progressively hones in on the algorithms that we want to use within a diversified portfolio. So what I've been doing is I'll start on a simple example which will explain what we're doing. So
yeah, just before you do, I might jump in there just to clarify the algo that Richard's about to show you is a portfolio algorithm. Within that one EA, we have multiple strategies, and each of the strategies is defined, and by using that definition, we can then have multiple trades occurring with different parameter sets. So I think that's what Richard's about to show you.
Yes, so I'll go to the actual settings for one of these sub-portfolios. So for example, in our Euro USD sub-portfolio, in our workflow process, we've got numerous systems that we test. One is a Donchian breakout system, another is a moving average crossover system. We've got different variations of trend following system. And then within our workflow process, we use that core design as a basis to then ultimately compile a portfolio of non-correlated systematic solutions, trend following solutions for each individual market. So for Euro USD, just as an example, when we go into the settings for just our Donchian breakout system, this is not the moving average crossover, but in this example, in our workflow process, where we developed ultimately 5 solutions here. These last 3 solutions I've deleted because they related to the moving average crossover. I just want to show people.
Rich, you might want to show something on screen. We're not seeing anything there. Yep, got you now.
Okay, so with our sub-portfolio for Euro USD, the way our workflow process operates, we've got 4 different core designs. This is only the results from one of the core designs, which is the Donchian breakout system. But what I've done is, just for the demonstration purpose here, I've stripped things back to just look at the Donchian breakout, as that is a very good trend following technique to catch what we call all trending opportunities and avoid what we call these type 2 errors, which means where you miss a potential outlier of significance. So the Donchian breakout is the system used to ensure that we at least get on board every significant trend that will occur.
Just before you move on there, Rich, you might want to explain what we're looking at.
Okay, so what we're looking at here is these are the configuration settings for a Donchian breakout. In this case, we've got 2 separate parameter settings for a Donchian breakout. This Donchian setting here, which refers to this line here, relates to a Donchian breakout system that uses a 950-day period Donchian breakout. It has uses an ATR period of 5 days for the ATR period, a stop loss multiplier. So when a trade is taken, when the Donchian breakout occurs, we'll see this visually in the example on the screen in a second, but I'll just explain this. When a trade is taken, an initial stop loss at 2 ATR is immediately placed, and then we trail it with a 2 ATR stop loss. We have no profit targets, so that's set to 0, no profit targets for these trend following solutions. And this relates to the fact that when it gets to 4 ATR, the stop automatically moves to break even. That's all this particular configuration of parameter settings are saying for that one system.
And those SMA numbers don't relate to the Donchian break, they relate to other variations and other strategies. So this is a multi-purpose trader setup, and so we're only looking at those parameter sets that Rich has just explained.
Yep. So in this case, we've got an example here of our workflow process that generated 2 Donchian systems. Interestingly, one had a 200 look back, one had a 950 look back, and a different range of settings. But that's just an outcome arising from our workflow process. So, but what I'll do now is I'm just going to visually take you to a back test using one of those systems, one of those, well, actually, no, 2 of those, sorry, one of those systems. I'll just get it. And then we'll run the back test. So just for the purposes of demonstrating visually what we mean by a breakout trader, I'm going to use one of those Donchian breakout selections, which is the 200 bar look back in this example. And I'll run now a back test using that setting for Euro.
So the EA has been designed to look at that CSV file and drag the parameters in and trade those variables.
That's it, mate. And what I'll do, I'll just get it up on screen so we've permanently got it just at our, won't be a sec, mate. Okay, so we've got the settings here. Now what I'll do, I'll just narrow this up a bit. So that's all the information we need. Now I'm going to run this back test for the period 2000 up to 2021, and we'll just visually see how it triggers the entry conditions. So
that Donchian, Rich, is that a 200 Donchian on
correct,
that chart?
Yeah. So in this chart here, we've got an indicator which is a 200 period Donchian. If you see there, the 200 period Donchian is the blue and the red line, which indicates the highest high and the lowest low over a 200 bar look back. And what we want is when we get a higher high or a lower low and we get this stepped movement of the Donchian bar, that's when we want an entry to be taken for this particular breakout technique. So where price is currently at the moment, we're very close to going short, pushing that the Donchian breakout, the lower band down. When that occurs, we take a short entry. So I'm just going to run it now. And we'll set, so there we go. So in that example there, you saw the trade being taken as it pushed that Donchian down lower. So we'd achieved a lower low, and therefore that was a breakout entry. Sitting in the back of this code, which we haven't explained to you, there's also a simple moving average, a 10-period moving average, which is simply there to ensure that momentum is on our side when this is taken. But the variables we're concerned with are just these ones here, the Donchian look back itself and the different ATR settings and the stop loss and trailing stop settings. I'll just let this run so visually you can see trades being taken. So that was a short trade. That now you'll see that these red lines here represent stops, and when they move, that's the movement of the trailing stop. So the trailing stop just clicked in and we saw it move. So I think people should have an appreciation for how this particular single solution EA works. You think, Fred, or shall I keep it going a bit longer?
I think generally speaking, everyone knows what we're talking about. The interesting thing is with the trailing stops, they're stepped, they're not continuous. So if you're wondering why it's jumping about, it's because the step change.
Beautiful, mate. Okay, so that's just to show you an example. I'll stop that. Now what I'm going to do is I'm going to run our optimized series. Sorry, not optimized, we won't use that word. But what I'm going to do is I'm going to run the two solutions that were generated through our workflow process. I'll do a quick back test and we'll see the result of it. And so what I want to do is I'm just going to delete these.
What Richard's doing there is just setting up the file structure, because the EA looks for a particular file reference to drag that information in.
So just so people are aware, for this next test, we're going to run two Donkians, which were the end result of our workflow process for Euro USD. So these two clearly will be robust and have signs that they're strong performers in more recent times, because that is an outcome we sought through our workflow process. But these are the two end results, the parameters. And I'll just run this now.
And while you're running it, you'll see the 200 period Donkin, but you won't see the 950.
Correct, mate. So in this case, you can see two EAs are fairly well active. You'll see two red lines, which mean that two trades are active occasionally. There's two there, two trades are active. I'm going to quickly fly through this now. And while we're doing that, we'll just see the results of the equity curve as it performs. Now, clearly, because this is the end of our work, these are the results from our workflow process, it's going to be a good result. And you can see a very good equity curve here. You can see a very good profit factor here. But that's just using two EAs. And also, I just need to explain. I've just opened up the expert properties now. You'll notice that we've assigned a 0.5% trade risk for each of those EAs. So that means for every trade that's taken, we apply 0.5% of our equity for the particular trade. So that means that if we have two trades operating at the same time, we're effectively trading 1% risk on our trade equity. So that's for those two particular EAs. Now, what I'm going to do is I want to show you how you can actually manually enter your own values and give a whole suite of diversified opportunities without actually having to do a workflow process itself. So for those traders or members of our forum who don't want to go through the painstaking task of doing all of the workflow processes, because it is quite a time-consuming journey, but I feel it's necessary, there are alternatives that they can use if they want to quickly get a result. It might not be optimal, but it is something that they can do. And what I'll do is I'm just going to show another I want to get rid of these. Now I want to use this here. Need to relabel that Euro USD. And I'm just going to open up to show you what I've done.
So this is a solution that hasn't been data mined. It's just been created based on your own idea of how you want to maybe trade a portfolio.
Exactly, mate. All I've done is I've said, well, the core design itself, which is a Donkin breakout, I'm satisfied that that is a robust solution that catches trends. I'm therefore confident, and I don't need to undertake any form of optimization because I'm happy with the technique, the core design itself. But what I do want is I want diversification of parameter sets within that core design. So for example, I'm using Euro USD for this. I've got 20 different solutions here, which are all of these solutions down here. And what I've done is I've said, all right, I want to start with a 100 period Donkin. And then what I want to do is I want to multiply that Donkin out for each level as I go down to slowly space out the look back. So I'm going to go 1.15. So I'm going to multiply everything by 1.15 and do my own range of Donkin lookbacks. Now, what I've got to do is I just want to round this. So I've just got to put a little formula in here. Won't be a sec. It goes round. Okay, so I copy this down. So that therefore gives me a broad range of Donkins starting from 100 up to 1,000 look back, which is a long look back of about 3-4 years or more. And I've got a big spanned range of different Donchian lookbacks. Now, I'm not using direct multiples of 100 here. I'm trying to establish it that I'm not using multiples of the same sequence. So, for instance, I'm using 100, then 200, then 300, then 400, because in reality, when you're using multiples like that, you're not actually getting variation of your Donchian lookback. All that's happening is that you're spacing out in the same increments your Donchian lookback. I haven't explained that well, Fred. Maybe you can help there a bit.
Yeah, I mean, you can go into the details, but I think it's sufficient to say that you're using a whole bunch of different values, just random values almost.
Yes. And all I've done is I've ensured that starting from a 100 bar lookback, so I'm not going too close. I'm sort of giving a bit of breathing room, but then I am going a fair way out with my lookbacks for those longer term solutions. I'm using an ATR period here, a standard 20 bar ATR lookback for all of them. And all I've done here is I have used the stop loss multiplier that with a shorter term lookback, I'm using a tighter stop. As I progress with my lookbacks to the longer term, I'm progressively increasing the width of my stop in terms of ATR. So these are ATR multipliers of the 20 period ATR. So with a tight 100 period Donchian lookback, which is to catch short-term momentum breaks or short-term trends, I've got an ATR distance of 1.5 to my initial stop. But with a long-term lookback of about 4 or 5 years, I've got a very wide initial stop of 6 ATRs.
The logic behind that being that over a longer period, you're going to have some major excursions in and out of the trend. So you want to give your stop loss a bit of room to breathe.
That's it, mate. Now, what I've also done is I've applied a trailing stop. So in the nature of our trend following efforts, we avoid using profit targets simply because we are targeting the left and right tails of the distribution of returns. We want to target the outliers, and we never know when we are riding an outlier. We never know how long they last. So rather than predict by using a profit target, we let our profits run. We're using the mantra here of to cut losses short and let our profits run. And to do that, we just apply a trailing stop after an initial stop's been placed. We've once again set a wide range of trailing stops that go from a tight trailing stop to a wide trailing stop as we go down in Donchian lookback. So that explains that. No profit targets for this column. Break-even multiplier, all that happens is once we get to 1.5 ATR, our price move upon entry, it then goes to a break-even position. Here, 1.8. Down here, when we get to 6.3 ATR, it goes to a break-even position. So that's it for the... Now, I've just manually set these settings, just with no optimization or whatever. Because I'm very confident with my Donchian breakout technique, I know that this diversified suite of systems is going to catch short-term trends, medium-term trends, and long-term trends. So I'm very happy with that, and I don't need to do any form of optimization. But I'm going to close that, and now we'll run it as a back test.
Yeah, so it's fair to say that those parameters are within the realm of a Donchian breakout system. Are almost random, aren't they, in terms of where it's going?
Absolutely, mate. I think, yeah, that we can say that definitely. So I'm going to run this now. Before we start, I'm just back at the expert properties. Now, I have 20 different strategy solutions here, so I want to apply a very small risk to each solution. So when I had 2 solutions in the previous demonstration, I had a 0.5% trade risk for each solution. But in this case, where I've got 20, I want a 0.05% trade risk. So that's half, that's a very small allocation of risk to each trade. But what I'm doing here is if I have 20 of these at 0.05 and they're all active, I am therefore, I think it's 1% risk, mate.
Yeah, the other thing to probably just remind I mean, members will know this, but others may not be aware that if we run into a minimum lot size calculation based on ATR, because if we've got a wide ATR stop and with a small risk, there's a good chance we're going to be looking for minimum lot sizes rather than, depending on our account balance to start with. What we've done in our basic EA is we won't actually take that trade if it blows in below the minimum lot size. So you probably wouldn't want to try this on any old EAs because you might end up with a minimum lot size in such a scenario where your actual risk is a lot higher than you think it is.
Yeah, don't try it on cotton, for instance. Some of the CFDs have a minimum lot size of 1 lot. Fortunately, I know this works because this is a Forex pair, Euro USD, where micro lots are offered. So we can, our minimum lot size is 0.01 or a micro lot. So I know that this works there, but you, as Fred says, you've got to keep your eye on those minimum lot sizes. But fortunately, his in-house EAs that he develops automatically looks at that for you and prevents you from trading if you bump up against that minimum lot size. So, mate, I'm ready to rock. So I've now applied my password and I'm ready to start trading it. So here we go. We're going to visualize it, and I'll slow it down a bit because it's quite exciting when we've got so many EAs in one.
Yeah, so potentially now we could have 20 trades running concurrently, couldn't we?
That's right, but with very minuscule risk applied to each. So you can see a large number of trades being placed here, but I'll just put the equity curve up. You can see we've already got a very high unrealized equity here. And I'll speed it up a tiny bit. Anything you'd like to say as it runs through, Fred?
Only that it's a beautiful thing.
So the principle behind this is what we're saying is that we certainly like diversifying our systems. So if you, for instance, had the opportunity to apply a 1% risk to one system or a 0.05% risk to 20 systems, we'd always favour the 0.05% risk to 20 systems. But unfortunately, the realities of live trading this on, for instance, here with Pepperstone, is that you quickly run into maximum allowable number of EAs operating at any one time. So Pepperstone's limit is 200 EAs or 200 open trades at any one time. So that means our ability to do this is limited if we want to do it all within the single portfolio. But you can, for instance, run multiple accounts in Pepperstone that allows you to diversify this way in your system design, which is something to consider if you want to go down this route of strongly diversifying within your systems themselves. As it's going through now, I'll just speed things up. You can see how active it is, but what it clearly shows is that when you have trending regimes, you're onto it and you get a big machine gun effect of many EAs firing with all different parameter sets. During non-trending conditions, it's pretty inactive. So the principle we're applying here is a bit like adding to winning trades. When you're in a trending condition, you apply many solutions, but when you're in a non-trending solution, not much activity occurs.
And that comes about because of the numerous look-back periods. Obviously, if you've got a strong trend, eventually you'll run and cross over each of those Donchian periods.
Exactly. That's a great short trade there, Fred. Look at that.
Wouldn't you like to see that every day?
Oh, look at the equity curve.
So can we just zoom that to the end then and see where we end up? Because it could get a little boring. I think everyone will get the idea that it's picking up the trends or it's picking up the breaks and then hopefully trending from there, cutting our losses short, trailing our winners.
The thing that people need to keep in their mind is, remember, there is no form of optimization here. We've applied our own parameter sets across a diverse range that simply meets the core logic of the design. So we like this because there is limited chance of achieving what they call a curve fit result by doing it this way.
So what's the report look like there?
Here we go.
Not too shabby at all.
Not too shabby. Profit factor of 1.76, a maximum drawdown of 7.27%. Very good result, mate.
Yeah, I could live with that.
Yeah, definitely. So that gives you an idea of what we're achieving here. Now, what I did do was I decided to apply those exact 20 parameter sets across my entire universe of markets. And interestingly, without doing the back test and showing you, I'll show you the results. So by doing that, I've got a little analysis file here where what I'm calling my diversified breakout sub-portfolio, this is of 20 solutions using exactly the same parameter sets, but across a broad range of different markets, such as soybeans, gold, silver, euro, NASDAQ, sugar, etc., as we go down. So in total, this is applied to a universe of 37 markets. Now, interestingly, this is another really good point to make. I'm getting a tiny bit fed up with people that say that the parameter set should work on every single market, the trend following parameter sets. Well, clearly that is not the case in our Forex world, where it's dominated by Forex and CFD worlds, because we can see in this case we've only got 27 of those markets. We've only got 14 of those total markets which have a positive result in a trend following context. These are the results, the profit results here. Now, these are all loss results ranging from almost close to break-even results. This is ranked from best to worst down here. But you can see that certain markets, such as natural gas, is a horrible loser. Now, this is not necessarily a symptom that it's a trend. It's not a trend following market, and I'll show you why. The reason natural gas does so appallingly is the impact of the Super-Contango on the swap, and I'll show you what I mean. Let's get rid of this. You might remember last year when the crude oil went into negative territory, and at that period of time it experienced what they call Super-Contango. That is a result of the fact that the costs of storage become so large that it applies such a large burden to the cost structure, which is reflected in the CFDs on the swap. So if I go to my natural gas, and if I look at Fred's beautiful little updated ADS data collector, have a look at the long swap on natural gas.
Big number.
It's a massive number, and what that means is it means when I run a back test long with that level of swap in place, it's prohibitive and I can't trade it. And I'll run a back test and show you what I mean, and that's why it produces such a large loss. It's not that the market doesn't trend. We clearly see there are trending periods within the market. It's because of the impact, in this case, of the costs of trading. So I'm going to now run that. Here we go, 1 sec. Oopsie daisy. Wait a sec, mate.
Yeah, what Rich is doing is he's renaming that CSV file because the EA has been structured in such a way that it looks for the EA, the symbol or the instrument name within the CSV file.
Okay, so I'm relabeling G. And I'm now going to run this on XNG. And we'll have a look at the trade results produced where we break down the costs using your CSV file, Fred, and I'll show you what happens. Ready to run now, XNG, and we'll see what happens. So it seems to be trading well visually, catching long trades using those variety settings. However, when we go to the equity curve, we see this horribly declining equity curve. Starting with a 2 million start, it now just, I'll race through it. It's catching trends okay, but what's eating it away is the costs.
Yeah. Well, you can see that too in the equity line.
Yeah.
Floating equities below the balance.
Absolutely, right.
Which is upside down from what we saw on the euro.
That's right. What I'm going to quickly do, well, I'll let it run because I want to generate the CSV file to show you what the costs are. If those level of swaps are maintained, I'll show you what the costs are. It's going to blow you away. Because with these particular suite of 20 different solutions, we've got very long holding periods, sometimes 1 to 2 years. The impact of cost of the swap of holding at these levels here is monstrous. Almost there, mate. Won't be sick. $2018. Now the thing is that this swap is currently we are in Super-Contango. In fact, we've been in Super-Contango since April 2020 for natural gas. That's a well-known fact in the futures market. The same as we were in Super-Contango in crude oil, which makes it prohibitive to trade long. We can trade short, we just can't trade long. So what I'm going to do now is I'm just going to bring you to the actual cost structure of that trade sequence we've just done. So this is the trade history that's generated as a CSV file. And you'll see that our short swap, we've actually got a slightly positive short swap, but this is the minus 121 per lot long. Now look at what it does on those long trades. When we're holding it for a long period, $11,000 in swap down here, mate.
That's crazy, isn't it? Yeah.
Now, if I add up what is the total cost of swap for my series, now this is assuming that that swap is constant across the entire trade series. That's $826,000 in swap for a 2 million balance. So clearly, you can't trade this long at the moment.
What would you? Let's go back to that CSV file and just trade short and see how we go.
That will now work. So I'm just going to go here. I'm opening this up now. In our parameter sets, you'll see this column called trade direction. I can set this to -1, which means that each of these solutions will only operate in the short direction. When it's 0, it means it's either long or short, and when it's +1, it's long. So in this case, I've now made sure that all of these will only trade short to overcome this long swap issue. So I'm just going to save it. And
the point there being, of course, is that we're still waiting for donkey and brakes, but they're only going to be taken on the short side.
So let's run it. Let's look at the equity curve as we go. Certainly not going to do the same amount of damage as it did.
Yeah, the trades short aren't particularly long, are they? Which is what we're seeing there.
There we go. There's a bit of a positive move. Notice no long trades with this revised parameter set.
Not particularly profitable either, though.
No, but it's certainly not wiping out our account, which is what was happening with the... and we haven't had any significant short moves yet. It will come. Here we go. This is... As it goes into Super-Contango, I think we do get some nice natural gas short moves. We'll soon see. No, not much.
Well, that wasn't particularly informative, but it does show the power of that EA, though, that you can trade long, short, or one or the other, or both. So that's pretty handy.
Yeah, let's look at the cost now of the swap from just trading short. I'll go to the history here. I think I've got to go to, where is it?
Well, it's a contribution from swap, but doesn't overcome the...
Here it is. We actually get a positive contribution, not much, $313 of swap for those short trades only. Anyway, that's interesting, isn't it? But
Yeah.
but what I have found is that back to where we were with this analysis, so that explains why this was such a poor performer, the natural gas. That's not because of its trend following, lack of trend following, it's more the case of the impact of swap. But there are certain instruments which are known for their mean reverting nature as opposed to their trend following nature. Things like the FTSE, the UK 100, the AUD New Zealand currency pair, Euro New Zealand, anything with Canadian dollar in it tends to have mean reversion in it as well. But these clearly are not trending instruments, they are mean reverting instruments. And I just want to explain what I mean there, in that if I go to, I want this sec, mate, I'll just clear this off. So what I've done here, we've already explained natural gas. So in terms of natural gas, if I look at it from, we can see it is a trending market, but in our instance, we know that the costs of trading were prohibitive, and that's what caused that a problem. So I'll get rid of that one. This is the UK 100. Now, it does trend. There is no question about it. It does trend. However, the trends are incredibly messy. So there is a price series going up here where there is an overall trend, but look at these, the reversion around this mean. That's what I'm referring to as there is mean reversion going on, which is making these trends messy, not clean cut, hard to trade. So if we wanted to trade UK 100 with a tight stop, we wouldn't be able to, because we'd be whipsawed out with many whipsaws if we entered on a donkey and break with a tight stop. Every time we had one of these mean reversion cycles over the overall trend, we're going to get whipsawed out. The only way to get through this trend would be to have an entry, but a very wide breathing room that avoided these whipsaws. But the cost of that is that you have a lower reward to risk, because you've got a much wider initial stop, which therefore significantly reduces your position sizing.
Yeah, yeah.
And
so what you're alluding to there, I think I might be putting words in your mouth, but you're alluding to the fact that this approach almost gives you some sort of an indication of a regime filter.
yes, yes. So what I'm saying is that all of these series, when you visually look at all of these series, they all trend, but they're not necessarily good quality trends that are tradable as trends. So things like AUD New Zealand, you clearly see trends here, but the mean reversion that's within the trend itself is making it very difficult to trade, and you get these numerous whipsaws. And that's why we therefore get these results down here. It's not that these markets don't trend, they do, but they're messy because mean reversion is starting to take a very strong hold in these particular markets. These up here, however, have trends, but they're very clean trends, and I'll show you what I mean. Euro USD is a very good trending instrument, and let's have a look at why. If I go to Euro USD, and we don't see the degree of mean, this trend here was a super trend, sorry. This was a super trend with, it was very simple trend, very little mean reversion within it. This was a very good trend here. Not much of these messy cycles. Here's another good trend here. Not much mean reversion within that existing trend or noise. So the lack of noise and mean reversion is making these far better to trend, hence why it's a good tradable instrument. And soybeans is another one that's been offering magnificent trends lately. Look at that clean trend. There's not much mean reversion going on in that trend. So a tight stop with a trail with soybeans from August 2020 on, you'd be doing very well in trend following terms in riding that trend.
That graph also is indicative of the fact that you've just got to be patient and wait for that breakout and then ride it as long as you can.
Absolutely, mate. And just to finish off this podcast, what I thought I'd do is now that we know there's a nice big trend in soybeans, let's see how soybeans performs as a final before we say adieu. Is there anything else you want to cover tonight, mate?
I think we've probably given them enough to think about.
As well, mate. So it's going to go here. I'm just going to run soybeans using that diversified strategy and see how it goes. Remember, very small risk applied per not much happening at the moment.
Oh, you know why, buddy? You've got it set at the sell only. Because we're using the same CSV file, it's on sell only. Yep.
Won't be a sec, mate. I'll just change that now.
Folks, you can see we're doing this live. We're not we're not cherry picking.
Sorry, Fred. Okay, that goes to 0. Well done, Fred. All right. Close. Save. Yep. We're certainly not cherry picking, mate. Okay. Ready to rock. Here we go. Whew, that's a bit better. There's some long trades in there now. Righto. Look at that beautiful long move. I do love this suite of diversified trend followers, mate. It looks beautiful, a beautiful thing.
Yeah, and I guess just a reminder that this is a random series. Our technique, our approach is to find a better than this. So, and we're also looking to trade something that's realistic for a retail trader. If you're trying to trade 20 EAs on 50 markets, it could be quite a number of trades fired off at once, which is a bit of a difficulty. Whereas our technique is such that we're trying to find the best half a dozen, the best 5 per instrument.
Yeah. That's great, mate. Almost coming to the end.
I want to see the big push at the end.
So do I, mate. When was it? It started in August 2020, this large bull move in the soybeans. Let's see if we ride that baby.
Well, we have to, don't we?
Yeah, yep. Yeah. All right, things are sideways. Continue a bit of a short move here. It's a bit like announcing a horse race, Fred. All right, ready for the long move? Here we go. Up she comes. Come on, baby. Racing now. Look at that. Look at that large kick up at the end.
Wouldn't you like to see that every time?
Oh, absolutely, mate. I just hone in on that. Oh, mate. Yeah, that would be very nice. Thank you very much.
What's the report look like on that, just for the hell of it?
Profit factor 1.89, max drawdown of 7.9.
Did you notice that the trenders are all got very low drawdown, even though we've got 20 trades running?
Yeah.
That's a function of the portfolio approach.
What I do find is that we get much better MAR ratio when we've got 20 solutions as opposed to, say, 2. So the collective do provide correlation benefits, reducing the drawdown effect.
Yep.
But that's to be expected, I suppose.
All right, mate, I think we've probably spoken enough for this evening.
Thanks very much, mate. And look, next week we'll get some questions from our forum members. Maybe we can bring some members on to explain how they're going. I know that Louis is doing very well with the in-house solution, and he's almost compiled his portfolios. And I know that Izzy has now compiled his SQX portfolios really well. So they're really at the pointy end of the exercise now. So they might need help on their VPS and that sort of stuff. So maybe next week we can invite them on board for a Skype session, and see what they've got to say.
Yep, sounds good, man. All right, buddy.
Okay.
Catch you next time. Cheers, mate.
Bye.